The global economic chessboard is shifting, and two of the biggest players, Japan and China, are making their moves. As the US tightens its grip with aggressive tariff hikes, these two Asian powerhouses find themselves at a critical crossroads. Are they forging a new economic alliance, or is this merely an attempt to prevent total collapse amid mounting pressure? The decisions made behind closed doors in Tokyo could reshape the future of trade, finance, and geopolitical stability for decades to come. For the first time in years, high-level economic talks between Japan and China have resumed. Are they aligning to counterbalance US pressure, or are their fractures too deep to mend? On March 22, 2025, Japanese and Chinese officials met in Tokyo, alongside South Korean representatives, to discuss economic cooperation. Japan's foreign ministry emphasized that maintaining open trade dialogue is crucial in an increasingly volatile global market. This meeting marks the first Japan-China high-level economic dialogue since 2019, a period filled with trade disputes, political tensions, and supply chain disruptions. The timing of these talks is crucial, as Japan and China must decide whether to reinforce economic ties or continue navigating their historically complex relationship. Meanwhile, the US has intensified its trade war with China, imposing an additional 20% tariff on key Chinese exports. President Trump defended the move, stating, "China has been taking advantage of us for too long. America will not be played." The decision has sparked concerns worldwide as increased tariffs drive up production costs, disrupt supply chains, and contribute to inflationary pressures in the US. China has responded by considering voluntary export restrictions on certain goods, attempting to mitigate economic imbalances. However, the impact is already spreading beyond China. Japan, as a major trade partner of both the US and China, finds itself caught in the middle. Trade volume between Japan and China dropped by 10% in 2024, according to Reuters. Economists predict that if tariffs continue to rise, Japan could face further disruptions in manufacturing and exports, particularly in the automotive and electronic sectors. Japan exported over $135 billion worth of goods to China in 2023, and any economic downturn in China would have severe implications for Japanese businesses. Japan's seafood industry has also suffered due to China's continued ban on Japanese seafood imports following the Fukushima wastewater discharge. While Japan hopes to resolve this issue through dialogue, China remains firm in its stance, linking trade policy with environmental concerns. This rift underscores the fragility of Japan-China relations, even as they attempt to find common economic ground. South Korea has joined the conversation, seeking stability in a rapidly shifting economic landscape. As a key player in semiconductor production, South Korea relies on raw materials from China and high-tech components from Japan. A deterioration in Japan-China trade relations could spell trouble for South Korea's tech industry, which is already vulnerable to global supply chain shocks. The South Korean Foreign Ministry stated, "We are at a turning point in history. Our cooperation must be built on economic security, trust, and shared regional goals." The effects of these developments are being felt in the US market as well. Wall Street analysts warn that disruptions in Asian supply chains could drive up costs for American businesses and consumers. The tariffs on Chinese goods mean higher prices for electronics, home appliances, and automobiles in the US. Companies like Apple, Tesla, and General Motors, which rely heavily on Chinese manufacturing, may be forced to pass increased costs onto consumers. A study from the US Chamber of Commerce found that the ongoing trade war could cost the average American household an additional $1,200 per year in goods and services. A Bloomberg report highlights that US inflation, already a pressing concern, could see another surge as trade tensions escalate. The Federal Reserve has been cautious about interest rate hikes, but prolonged economic uncertainty could push them to take more aggressive measures to control inflation. Retailers such as Walmart and Target have already issued warnings about potential price increases due to supply chain disruptions in Asia. Furthermore, as Japan and China attempt to stabilize their trade relations, there is speculation that they may seek alternative markets to reduce reliance on the US economy. If Japan strengthens trade ties with China instead of the US, American exporters could see diminished opportunities in Asia. This would particularly impact the US agriculture sector, which relies on Japan as a key buyer of beef and grain. In 2023, Japan imported over $14 billion in American agricultural products. Any shift in trade preferences could devastate American farmers, already struggling with supply chain disruptions and climate-related challenges. Investors and financial institutions are closely monitoring the situation. If Japan and China establish a stronger trade pact, this could accelerate the global shift away from the US dollar as the dominant trading currency. Some analysts predict that a China-Japan trade agreement could lead to a greater reliance on the yuan and yen, reducing the influence of the dollar in Asia-Pacific markets. Over the past 2 months, financial markets in the US have been rattled by the accelerating trade war and rising inflation. The Dow Jones Industrial Average has experienced increased volatility, with sharp declines following the announcement of new tariffs on Chinese goods. Investors fear that prolonged economic uncertainty could lead to slower corporate earnings and reduced consumer spending. Major U.S. retailers such as Walmart, Costco, and Target have already issued profit warnings, citing higher import costs and supply chain disruptions from Asia. Electronics retailers are particularly vulnerable as semiconductor shortages and price hikes on Chinese manufactured goods hit the market. Apple shares have dropped nearly 12% in the last 8 weeks, reflecting concerns over rising production costs and supply constraints. Inflation has remained persistently high, with the Consumer Price Index, CPI, rising by 0.6% in February alone, the highest monthly increase in over a year. Core inflation, which excludes food and energy prices, has also surged as manufacturers and suppliers pass higher costs onto consumers. The Federal Reserve now finds itself in a difficult position. Having signaled a pause in interest rate hikes earlier this year, the Fed is now under pressure to respond to the inflationary spike. Analysts predict that another rate hike may be imminent, further squeezing credit markets and increasing borrowing costs for businesses and consumers. The American housing market has also begun to feel the effects. Mortgage rates have climbed past 7%, pushing home affordability to its lowest level in over a decade. With inflation eroding consumer purchasing power, home sales have declined sharply, triggering concerns about a broader economic slowdown. At the same time, U.S. manufacturing has taken a hit, with factory activity contracting for the 3rd straight month. American automakers, already struggling with high labor costs following last year's historic United Auto Workers (UAW) strikes, now face rising material costs due to tariffs on Chinese steel and aluminum. While Washington defends its tariff strategy as a necessary move to counter China's economic influence, the immediate consequences are clear: rising prices, market instability, and growing fears of a recession. As Japan and China consider their next moves, the U.S. economy hangs in the balance, caught between its aggressive trade policies and the global realignment they may ultimately trigger. The world now watches as Japan and China navigate these economic tensions. Will they forge a stronger partnership to counter U.S. pressure, or will their long-standing differences prevent meaningful cooperation? The outcome will have lasting consequences for global trade, inflation, and economic stability. If Japan and China align their economic interests, the U.S. could face an uphill battle in maintaining its dominance in global trade. If they fail to reach an agreement, however, it could lead to further fragmentation of global markets, increasing volatility and uncertainty for businesses and investors alike. One thing is certain: the decisions made in Tokyo, Beijing, and Washington will determine the economic balance of power for years to come.